There are technical analysts who codified chart patterns and quantitative investors who developed intricate formulas. And then there is Bernard Baruch. He was not a system builder. He was a market philosopher, a self-reliant operator who navigated the most treacherous and unregulated decades of Wall Street with a set of timeless common-sense principles. He was the definitive lone wolf, a speculator and investor who rejected the crowd, ignored the tips, and built an immense fortune through a strict personal code of conduct. This is not the story of a secret formula or a complex indicator. It is a deep dive into the foundational wisdom of a man who understood that success in the markets is, first and foremost, a victory over oneself. While others sought to master the market, Baruch sought to master his own impulses, his own greed, and his own fear. His 10 golden rules are not a trading system in the modern sense. They are a doctrine for survival, a guide to rational behavior in an irrational environment. In this first part of our analysis, we will deconstruct the 5 foundational principles that formed his worldview, the rules of preparation, mindset, and research that he considered the absolute prerequisite for anyone who dared to enter the speculative arena. Rule number 1. Treat speculation as a full-time profession. The first and perhaps most uncompromising of Baruch's rules was his insistence that speculation is not a hobby. He stated, "Don't speculate unless you can make it a full-time job." This principle formed the barrier to entry in his mind, separating the serious operator from the amateur destined for failure. In his era, and indeed in our own, the market is often portrayed as an easy path to wealth, a game that can be played casually in one's spare time. Baruch viewed this notion with contempt. He understood that the market was a zero-sum arena, a relentless intellectual and psychological battle against the sharpest, best informed, and most dedicated minds in the world. To treat this battle as a part-time diversion was, in his view, a form of financial suicide. The logic behind this rule is a deep appreciation for the level of commitment required to succeed. For Baruch, full-time did not simply mean the hours spent in front of a ticker tape. It meant total, all-consuming intellectual and emotional immersion. It meant doing the exhaustive research, constantly monitoring market conditions, studying macroeconomic trends, and most importantly, engaging in the continuous and difficult work of self-mastery. He knew that the market does not grant profits based on hope or casual interest. It rewards only diligence, preparation, and unwavering focus. The amateur who dabbles in the market after a long day at their primary job is bringing a tired, distracted mind to a battlefield where their opponents are armed with decades of experience, immense capital, and a singular focus on separating the public from its money. This perspective was forged in the context of his time. The Gilded Age was filled with so-called gentlemen speculators, wealthy individuals who played the market for sport, often with disastrous results. Baruch, who started with a very small capital base, could not afford such a cavalier attitude. For him, every dollar was at risk, and every decision had to be weighed with the utmost seriousness. He saw speculation not as a game, but as the most challenging profession on earth. In the modern era of 24/7 news cycles, instant mobile trading, and a constant deluge of information, this rule is more relevant than ever. The accessibility of the market has created an illusion of ease, but the professional operator understands that this constant stream of data is not an advantage. It is a distraction. True focus, the kind Baruch demanded, is about filtering out this noise, concentrating only on the essential facts, and dedicating the significant mental energy required to make rational decisions under pressure. His first rule, therefore, is a profound warning. Respect the arena, or the arena will destroy you. Rule number 2, beware of all inside information and tips. The second pillar of Baruch's self-reliant philosophy was his profound and unshakable skepticism. His rule was unequivocal. Beware of barbers, beauticians, waiters, of anyone, bringing gifts of inside information or tips. In an era where the market ran on rumors and manufactured hype, This principle was his primary defense mechanism against manipulation and his own human desire for an easy shortcut. He understood a fundamental truth that most market participants never learn. A true tip is a logical impossibility. His reasoning was a masterclass in second-level thinking. First, he would ask the simple question, if the information is so valuable, why is it being shared with me? A truly valuable piece of inside information is the most precious commodity on Wall Street. The possessor of such information would not be spreading it around for the benefit of others. They would be quietly and quickly acting on it themselves. By the time a tip reaches the general public, its value, if it ever had any, has almost certainly been fully exploited. Second, he recognized that the provider of the tip almost always has their own agenda. In the early 20th century, the market was dominated by manipulative pools, syndicates of powerful operators who would conspire to drive up the price of a stock. They would accumulate a large position quietly, then spread bullish rumors and tips through the press and brokerage houses to lure in the public. As the public stampeded in to buy, the pool operators would unload their shares at inflated prices, leaving the amateur bag holders with the inevitable losses when the price collapsed. Baruch saw tips not as gifts but as weapons being used against him. Most importantly, Baruch understood that trading on a tip, even if it proves profitable by sheer luck, is a strategically ruinous habit. A position taken based on a tip has no intellectual foundation. The speculator does not know the real reason for the purchase, and therefore, they can have no rational basis for when to sell. Do you sell when the price doubles? Do you sell when it falls by 10%? Without an underlying thesis, every subsequent decision is a guess, driven by emotion. The trader becomes a passive passenger, hoping for the best, a state that Baruch considered anathema to professional operation. His insistence on ignoring tips was the cornerstone of his lone wolf persona. It forced him to rely on his own research, his own analysis, and his own judgment. It was a declaration of intellectual independence, the only path to long-term survival in a game designed to exploit the credulity of the crowd. This brings us to a critical question for the modern era of social media and instant communication. Baruch's world was one of whispers in a barbershop. Ours is one of a global fire hose of information on Twitter, Reddit, and Telegram. Is this flood of information the modern equivalent of Baruch's barber's tip, a new, more sophisticated mechanism for manipulating the public? Or is it a genuine democratization of information that levels the playing field? Let us know your view in the comments. Rule number 3. Get all the facts before committing capital. Having rejected the easy path of tips and rumors, Baruch needed a robust alternative. He found it in his third and perhaps most laborious principle. Before you buy a security, find out everything you can about the company, its management and competitors, its earnings and possibilities for growth. This was the source of his true edge. In an age dominated by pure price speculation and market manipulation, Bernard Baruch was a relentless, obsessive researcher. This rule was the engine of his operation, the principle that allowed him to replace gambling with calculated, informed risk. He understood that while the short-term movements of a stock might be driven by emotion and manipulation, its long-term trajectory was ultimately tethered to the fundamental reality of the underlying business. Getting the facts for Baruch was a far more comprehensive process than it is for many today. It was not a passive act of reading a single annual report or a brokerage summary. It was an active, deep, and often grueling investigation. If he was interested in a railroad, he would study its route maps, its debt structure, the condition of its tracks, and the political landscape of the territories it served. If he was analyzing a mining company, he would become a temporary expert on the global supply and demand dynamics of that specific commodity, studying production figures, industrial consumption rates, and the potential for new discoveries. He was, in essence, a proto-fundamental analyst, practicing a form of deep business research long before it was formalized by others. A classic example of this principle in action was his hugely successful speculation in American Smelting and Refining Company. He did not simply buy the stock because it was moving. He undertook a deep investigation into the entire copper and metals industry. He learned that the powerful Guggenheim family was making a strategic move to consolidate the industry and take control of the company. He studied the global copper market, understanding that industrialization was creating a massive long-term demand for the metal. He analyzed the company's financial structure and realized that a reorganization under the expert management of the Guggenheims would unlock immense value. He was not betting on a chart pattern. He was betting on a well-researched industrial and corporate restructuring. His thesis was built on a solid foundation of facts. This deep knowledge gave him the conviction to take a large position and, more importantly, to hold it through the market's inevitable, meaningless daily fluctuations. It was this dedication to exhaustive research that separated him from the speculators who were merely betting on symbols on a ticker tape. Baruch was betting on the tangible realities of business and economics. Rule number 4, limit your bets and watch them closely. Baruch's fourth principle stands as a direct challenge to one of the most widely accepted financial doctrines of the modern era. His rule was, don't buy too many different securities. Better to have only a few investments which can be watched. This is the principle of concentration over diversification. While modern portfolio theory preaches the virtue of spreading risk across a wide array of assets, Baruch believed this was a recipe for mediocrity and paradoxically a source of hidden risk. His logic was rooted in his third rule about getting all the facts. He knew that the kind of deep, exhaustive research required to truly understand an investment was an incredibly time-consuming and mentally demanding process. It was simply not possible for one person to maintain that level of expertise across dozens of different companies. He argued that so-called diversification was often just an admission of ignorance. An investor who spreads their capital across 50 or 100 stocks does not eliminate risk. They merely ensure that they know very little about any of their individual holdings. For Baruch, true risk management did not come from owning many things, but from knowing everything about the few things you own. By concentrating his capital into a handful of carefully selected positions, he could maintain an intimate and up-to-the-minute understanding of each one. This deep knowledge gave him the ability to act decisively when conditions changed and provided the conviction to hold on during periods of market turmoil. Furthermore, the principle of concentration acted as a powerful quality filter. If you know that you can only make a few bets, you become extraordinarily selective. You will only commit capital to your absolute best ideas, the ones that have survived the most rigorous scrutiny and offer the most compelling potential for profit. This stands in stark contrast to the diversified investor, who may feel comfortable adding a mediocre idea to their portfolio simply because it is just one of many. The mental discipline required to operate this way, to run a concentrated portfolio and ignore the siren song of 1,000 other opportunities, is immense. This internal battle against the desire for easy answers and the fear of being wrong is timeless. It is captured with unparalleled clarity in the foundational text on market psychology, Edwin Lefebvre's Reminiscences of a Stock Operator, a book based on the life of Jesse Livermore. To make its century-old wisdom immediately actionable for today's market participants, we have linked in the description an essential modern resource. The 2025 Annotated edition, a version featuring an in-depth chapter-by-chapter analysis for the modern speculator by Max Davidson. Rule number 5, maintain flexibility through constant review. The final foundational principle in our first block is the antidote to dogma and complacency. Baruch's rule was, make a periodic and thorough appraisal of all your investments to see whether changing developments have altered their prospects. This is the principle of adaptability. Baruch understood that the world, and by extension the market, is not a static entity. It is in a constant state of flux. New technologies emerge, consumer tastes change, new competition arises, and the macroeconomic climate shifts. Therefore, a brilliant investment thesis formulated today could be rendered completely obsolete by the events of tomorrow. The buy and forget mentality, he believed, was a dangerous path to ruin. This rule forces the operator to constantly revalidate their original reasons for owning a security. The critical question to be asked during each review is not, has the price gone up or down? But rather, are the facts that supported my initial purchase still true? If a company's competitive position has eroded, if a new technology threatens its business model, or if the management has made a series of poor decisions, then the original thesis is invalidated. In such a case, the position must be sold, regardless of whether it is showing a profit or a loss. The price is irrelevant. The change in the underlying facts is the only thing that matters. This principle of constant review is what allowed Baruch to navigate multiple decades of profound economic and technological change. It ensured that his portfolio was always aligned with the realities of the present, not the assumptions of the past. It is the rule that separates a strategic, adaptive operator from a rigid, dogmatic investor who holds on to a deteriorating position out of loyalty or hope. These first 5 rules constitute the intellectual and psychological foundation of the Baruch method. They are a complete system for preparation, analysis, and mindset, the necessary groundwork that must be laid before a single dollar is ever put at risk. In the first part of our analysis, we deconstructed the 5 foundational principles that formed the intellectual bedrock of Bernard Baruch's methodology. These are the rules of preparation: the commitment to treat speculation as a full-time profession, the unwavering skepticism towards tips and insider information, the relentless pursuit of all available facts, the strategic wisdom of a concentrated portfolio, and the essential discipline of constant review. These principles are what the operator does in the quiet of his office, the laborious work of building a sound thesis before a single dollar is put at risk. Now, we transition from the realm of preparation to the arena of action. The next 5 rules are the dynamic operational principles that governed Baruch's behavior during the heat of the battle. These are the rules of execution, of psychological mastery, and of ultimate survival. It is in the application of these rules that we see how a well-researched analyst transforms into a profitable, long-term operator who can not only build a fortune, but more importantly, protect it from the market's inevitable storms. Rule number 6: cut your losses quickly and cleanly. This is perhaps the most famous and most frequently ignored piece of wisdom in all of finance. For Bernard Baruch, it was not a suggestion. It was an ironclad, non-negotiable law. His formulation was simple and brutal. Learn to take your losses quickly and cleanly. Don't expect to be right all the time. If you have made a mistake, cut your loss as quickly as possible. This principle is the very heart of capital preservation and the primary separator between the professional who survives and the amateur who is inevitably wiped out. To understand the depth of this rule, one must recognize that Baruch believed a speculator's primary job was the management of 2 distinct yet interconnected forms of capital: the financial capital in their account and the emotional capital in their mind. This rule is designed to protect both. The protection of financial capital is a matter of simple, brutal mathematics. A small loss of 10% requires only an 11% gain on the remaining capital to get back to even. A catastrophic loss of 50%, however, requires a 100% gain to recover, a monumental and often impossible task. Baruch understood that all great speculators are wrong a significant portion of the time. The market is a probabilistic environment, and no amount of research can guarantee a successful outcome on any single trade. Since losses are an inevitable part of the game, the only variable a speculator can control is the size of those losses. By cutting them quickly, he treated them as small, manageable business expenses, the cost of gathering information from the market. A small loss was simply the market telling him his initial thesis was incorrect, information he paid a small price to acquire. More profoundly, however, this rule was about the preservation of emotional capital. Baruch knew that nothing is more mentally debilitating and judgment-destroying than nursing a large, open loss. A losing position consumes an operator's mind. It fosters a state of hope, a desperate, irrational desire for the market to prove you right. It drains focus, prevents the clear-headed analysis of new, better opportunities, and often leads to even worse decisions in a frantic attempt to get even. By taking a loss quickly and cleanly, Baruch performed a kind of mental surgery. He amputated the failing trade, accepted the small financial cost, and most importantly, liberated his mind to focus on the next opportunity with a clean slate. This discipline is a direct countermeasure to one of the most powerful and destructive human biases: loss aversion. Behavioral economists have proven that humans feel the pain of a loss approximately twice as acutely as the pleasure of an equivalent gain. This is why amateurs will cling to a losing stock, unable to make the loss real by selling, while simultaneously being too eager to sell a winning stock to lock in a small pleasure. Baruch's rule was a logical override for this flawed emotional wiring. Rules number 7 and 8. The unified doctrine of profit-taking. If his rule on cutting losses was his primary defense, then his philosophy on taking profits was his secret to long-term sanity and success. These two rules must be understood together, as they form a complete unified doctrine for battling the emotion that is just as destructive as fear: greed. The rules are: don't try to buy at the bottom and sell at the top. It can't be done, except by liars, and know when to sell stocks that have shown a profit. It is foolhardy to try to squeeze out the last eighth or point. This is the famous Baruch principle of selling too soon. On the surface, this seems counterintuitive. Why would one intentionally leave money on the table? Baruch's reasoning was a masterclass in practical psychology. He understood that the final phase of a bull market or a soaring stock is the most dangerous. This is the period of public euphoria, the blow-off top, where prices become detached from all logic and are driven purely by the madness of crowds. While it is tempting to participate in this final parabolic ascent, it is also the phase where the risk of a sudden catastrophic reversal is highest. Baruch's strategy was to cede this final, dangerous portion of the trend to others. He was content to capture the meat of the move, the solid, predictable middle portion of a trend, and then to exit while the market was still strong and liquidity was high. He stated, "I made my money by selling too soon." This was not an admission of flawed timing. It was a proud declaration of his disciplined strategy. It was a strategy that prioritized the certain realization of a substantial profit over the uncertain and risky pursuit of a perfect exit. This doctrine found its ultimate expression in the single greatest market call of his career, his exit from the stock market before the great crash of 1929. This was not the result of a single data point, but the culmination of all his principles, with his profit-taking rules serving as the final trigger. The context was the Roaring Twenties, a decade of unprecedented prosperity and rampant speculation. A new era of permanent economic growth was proclaimed. The public, for the first time in American history, had entered the stock market en masse. Everyone was an expert and everyone was getting rich. For Baruch, this widespread euphoria was a deeply troubling sign. He saw that the market was no longer being driven by the cold calculation of value, but by the hot, irrational emotions of the crowd. The final catalyzing signal for him is now one of the most iconic anecdotes in financial history: the story of the shoeshine boy. In early 1929, while having his shoes shined, the boy began to offer him unsolicited stock tips, explaining which stocks he was buying and why they were sure to go up. For Baruch, this was the ultimate signal of a market top. It was not that he disrespected the boy. It was what the boy's participation signified. It was the final definitive evidence of market saturation. When the person on the absolute lowest rung of the economic ladder, the individual furthest removed from the centers of finance and information, is not only in the market but is so confident that they are giving advice to a Wall Street veteran, it means that every last potential buyer has been drawn into the speculative vortex. There is no new money left to fuel the advance. There is no one left to buy. The only participants who remain are potential sellers. At that moment, the market is resting on a knife's edge, exquisitely vulnerable to the slightest shock. Upon returning to his office, Baruch methodically began to liquidate his substantial stock portfolio, selling into the still strong market. By the summer of 1929, he was almost entirely in cash and government bonds. He then took the final step, building a significant short position, betting on a market decline. When the crash came in October, while the nation was plunged into financial ruin, Bernard Baruch preserved his fortune and profited immensely. It was the ultimate vindication of his rules. He got the facts, he ignored the herd, and he knew when to sell. Rule number 9. Ignore the herd and think for yourself. This principle is the very essence of the lone wolf persona. It is the intellectual and psychological foundation that makes all the other rules possible. Baruch understood that the market is a machine for exploiting the psychological weaknesses of the masses. He knew that herd behavior, the human instinct to seek safety and validation in the consensus view, is the single most reliable path to financial ruin. The consensus is, by its very definition, almost always wrong at major market turning points. At a market bottom, the consensus is one of overwhelming pessimism and fear, creating generational buying opportunities for those who can think independently. At a market top, the consensus is one of unbridled euphoria and greed, creating the ideal environment for the disciplined operator to sell their holdings to the crowd. The price of this intellectual independence, as Baruch knew well, is often a period of looking wrong. To be a true contrarian is to stand against the prevailing emotional tide, which can be an intensely uncomfortable and psychologically taxing experience. It requires an almost superhuman level of conviction in one's own research and analysis. This is why his third rule, get all the facts, was so critical. His deep factual understanding of a situation was the source of his courage. He could ignore the herd because his decisions were not based on the herd's opinion, but on his own laborious research. In practice, Baruch cultivated this independence by deliberately isolating himself from the daily chatter of Wall Street. He did not sit in the smoke-filled boardrooms of brokerage houses, listening to the gossip and the rumors. He often worked from his home or a quiet office, protecting his own thought process from being contaminated by the prevailing sentiment. This rule is a call for a radical form of self-reliance. It demands that an operator trust their own analysis above all else, to have the courage to buy when others are panicking, and the even greater courage to sell when others are euphoric. Rule number 10. Always keep a good part of your capital in a cash reserve. This is the final and perhaps most strategically profound of Baruch's rules. In a world that relentlessly preaches the importance of being fully invested, Baruch was a staunch advocate for the strategic power of cash. For the average investor, cash is often seen as a dead asset, a drag on performance that earns nothing. For Baruch, cash was optionality. It was a strategic position, and often the wisest and most profitable position an operator could hold. His insistence on maintaining a significant cash reserve served two critical purposes, one defensive and one offensive. The defensive power of cash is primarily psychological. An operator who is fully invested and leveraged to the hilt is psychologically fragile. They are at the mercy of the market's every whim. A sudden, sharp decline can trigger margin calls and force them to sell their best holdings at the worst possible time. An operator with a large cash reserve, however, is psychologically robust. They can endure market drawdowns with equanimity, knowing they have the resources to wait out the storm without being forced into a panicked decision. Cash provides the freedom to think rationally when others are consumed by fear. Even more important, however, is the offensive power of cash. Baruch understood that the greatest investment opportunities of a lifetime are not born in times of calm, but in times of crisis. Market panics, crashes, and forced liquidations are the moments when valuable assets go on sale at absurdly low prices. In these moments, as the saying goes, cash is king. The operator who has the foresight to be holding cash during a panic is in a position of immense power. While others are being forced to sell, they have the ability to buy, to name their price, and to lay the foundations for the next great fortune. Baruch's own exit from the market in 1929 was not just a defensive move to preserve his capital. It was a strategic move to convert his assets into the one tool, cash, that would allow him to capitalize on the generational bargains that he knew the subsequent depression would create. This rule is the ultimate expression of the patient hunter. It is about resisting the temptation to be constantly active and instead preserving one's resources for the rare moment when a truly extraordinary opportunity presents itself. The first step in building a successful system is building the habit of disciplined study. The philosophy of Bernard Baruch is not an abstract theory. It is a set of principles that requires reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the 10 rules of Bernard Baruch are more than a guide to speculation. They are a complete philosophy of rational action in an irrational world. In reviewing them, a clear and powerful theme emerges. His genius was not rooted in a complex secret formula or the ability to predict market movements. It was rooted in his profound understanding of the one variable that never changes, human nature. His entire doctrine, his insistence on facts over tips, on concentration over diversification, on cutting losses and selling too soon, on ignoring the herd and holding cash, was a brilliantly designed system for managing not just his capital, but for managing himself. He understood that the greatest risks in the market came not from the charts or the balance sheets, but from the destructive internal impulses of fear and greed. His rules were a lifelong practice of cultivating discipline, patience, skepticism, and intellectual independence. They are a timeless reminder that the ultimate key to survival and success in the markets is not the mastery of a complex system, but the simple and yet infinitely difficult mastery of oneself.